Right, in this chapter, let's get on with the RSI before we actually move on later on into combining all three indicators and avoiding their mistakes, remember the types of trades which we get in and then they go like this, and ensuring we get onto momentum trades which go in this direction. Again, whether we're spread betting, CFD trading, using futures, stocks, whatever it is. So I'll just take a detour and get onto the RSI, which is the third momentum indicator that I wanted us to look at. Similar rules of interpretation, except in this case with the RSI, because it's a single indicator, you don't have a crossover as such. What you do have, two lines, we'll see an example of this in a second, which are drawn at around the 80 and the 20% mark, depending on how the indicator is constructed. And we talk about a crossover of those lines, suggesting a sell signal. So it goes from overbought territory, crosses over, and that's a sell signal. And similarly, when it goes down, buy signal when it crosses on the other side. So that's the nature of the crossover. Oversold and overbought as before, except, as with the stochastic, it might be, if this is the grid, and then you've got this line at the 80 level, this there, and this is the 0, down here and the 100 up here. What sometimes happens with this indicator is that overbought can be here as opposed to necessarily being all the way up here, and similarly with oversold can be here instead. It can be here instead of being all the way down there. So what is defined as oversold and overbought depends upon where it's been. It's relative rather than absolute. It's relative to where it's recently been, as opposed to in absolute terms saying that can only be overbought if it's all the way up here. It can be overbought even if it's here, because if all that the price has done is done this and has never been in this higher territory, then that becomes relatively overbought. We're going to look for divergences as before. The formula for this, by the way, is this. Now, we don't need to know the formula, but it's useful to know since we're specialists and we're specializing in momentum indicators. It's the average price change on up days divided by the average price change on down days. And it's calculated in this way, so it's converted into a percentage using that methodology. Now, the nature of the calculation, the nature of the mathematics, means that it can remain overbought or oversold for prolonged periods of time, unlike the MACD, which tends not to have that problem. And that's because of the nature, again, it's the nature of the maths. When you do calculations which involve divisors like this, what you sometimes find, unlike the MACD, which is more a subtraction, what you find is that this can stay overbought and oversold for prolonged periods of time, and that in itself can give rise to false signals, and that's why we use more practical rules of interpretation for this than the textbooks would suggest. Now, we'll go through all of this in detail. We'll go through actual examples in detail, but I just wanted to, at the moment, give the introduction to the background, and we'll learn all of this by doing rather than by just me describing as we go forward. But for now, it's just the intro to the RSI.